Every month, millions of Americans check their brokerage accounts and see a number that makes them feel like they've figured something out. A dividend deposit. Maybe $180, maybe $700, maybe a few thousand if they've been at this for years. And that cash hitting the account? It feels like winning. Like the system is working. Like passive income is real and it's finally working in their favor. What they're not calculating is the silent number, the one that never shows up in a notification. The cost of choosing that income stream over the alternative. And by the time we're done today, that feeling is going to look a lot more complicated. I want to be clear up front. This is not a dividends bad index funds good video. The real answer is more interesting than that, and it depends entirely on a question most people never stop to ask. We're going to run the actual math. We're going to talk about the one decade when dividends completely saved portfolios that pure growth investors lost. And we're going to identify the specific type of dividend stock that, according to 90 years of data, actually does beat the market. But we're also going to talk about the number most dividend investors have never calculated, the one that quietly drains wealth while monthly deposits are making them feel rich. Let's start with what's actually happening when a dividend hits your account. When a company pays out a dividend, something most people never notice occurs on the exact same day. The stock price drops by almost exactly the same amount. A company trading at $50 a share pays a $2 dividend. The next morning that stock opens at roughly $48. You didn't gain $2. You moved $2 from inside the company into your pocket. Your total position value is unchanged. This is called the dividend irrelevance principle, and it was proven mathematically by Nobel Prize-winning economist Merton Miller in 1961. In the real world, prices are messy and don't move with perfect precision. But the core logic holds. Dividends don't generate new wealth. They redistribute existing wealth from inside the company back to the shareholder. You're receiving your own capital back in a different form. If that's true, why do tens of millions of Americans build their entire investment strategy around dividend income? Because the psychological experience of receiving regular cash flow is genuinely powerful. When income hits your account every quarter, you feel like an investor, not a gambler waiting for prices to move. Studies consistently show that investors who receive dividend income stay in the market through downturns better than investors watching unrealized gains evaporate. That behavioral advantage, not panic selling at a 30% bottom, is worth real money over a lifetime of investing. And there's a historical argument for dividends that's legitimately strong. Going back to 1960, if you invested $10,000 in the S&P 500 and automatically reinvested every dividend, approximately 85% of your cumulative total return came from those reinvested dividends and the compounding effect, according to Hartford Funds data, through 2025. Without reinvestment, you leave the majority of the wealth-building engine idle. But here's where the conversation gets complicated. That 85% statistic is an argument for the S&P 500, not for a dedicated dividend portfolio. The index captures dividends and price appreciation. The actual question isn't dividends versus no dividends, it's whether a portfolio specifically built around dividend-paying stocks beats a simple total market index fund that also holds those dividends, plus everything else. When you put real numbers on that comparison, the gap is hard to ignore. The Schwab U.S. Dividend Equity ETF, ticker SCHD, is the standard bearer of dividend investing. Around 100 high-quality American companies with strong dividend track records. Yields roughly 3.5 to 4%. It's what most serious dividend investors point to as the right way to do it. The Vanguard S&P 500 ETF ticker, VOO, is the plain index fund. Yields around 1.3%. But it owns a slice of every major American company, including the fastest-growing ones. Over the past 10 years, the Schwab Dividend Fund returned 12.86% per year. That is objectively a good number. The Vanguard Fund returned 15.62% per year, a gap of 2.76% annually. That sounds almost negligible when you say it out loud. Run $100,000 through that difference for 10 years. The Schwab Fund grows to roughly $334,000. The Vanguard Fund grows to roughly $433,000. That's $99,000 gone, nearly another full original investment missing from the dividend portfolio. And just in 2024 alone, the gap was even more stark. The Vanguard Fund returned 24.98% while the Schwab Dividend Fund returned 11.66%. Same year, same market. Very different results, but the performance gap isn't even the most important number to understand. What really changes the math is something the dividend community almost never talks about openly. Here's the number most dividend investors never calculate: the tax drain. Every dividend that hits your brokerage account is taxable income in the year it's received. Not when you retire, not when you sell. Right now, this year, even if you automatically reinvest every single dollar, even if you never spend 1 cent of that income, the IRS doesn't care about your reinvestment plan. You owe taxes on that income immediately. Here's what that actually looks like in practice. Researchers modeled two funds, one tracking the S&P 500 with a 1.3% dividend yield, and one tracking a high dividend index at 4.7%. Both produce identical 10% gross returns per year. An investor pays the standard 20% qualified dividend rate and reinvests everything automatically. After 20 years of identical gross performance, the high dividend investor ends up approximately $75,000 poorer, not from bad picks, not from fees, purely from paying annual taxes on income they never even touched, while the index investor's full balance kept compounding uninterrupted. Tax-deferred compounding is one of the most powerful forces in personal finance. Every year you pay tax on dividends is a year that capital stops compounding and exits your portfolio permanently. This is why Warren Buffett's company, Berkshire Hathaway, has never paid a single dividend in nearly 60 years of existence, not once. Buffett has said explicitly that paying dividends is one of the least efficient ways to return capital to shareholders. Every dollar that leaves as a dividend gets taxed before it can work again. He'd rather let that money compound inside the business, on the shareholders' behalf, with zero annual tax friction. Berkshire shareholders have built extraordinary wealth over 5 decades without ever seeing a deposit hit their accounts. And now for the part that pure index fund advocates quietly hope you skip over: the lost decade. January 2000 through December 2009. The S&P 500 produced a negative total return, minus 0.80% annually for 10 consecutive years. The dot-com collapse and then the financial crisis wiped out gains twice in the same decade. If your portfolio was built purely around price appreciation and broad market exposure, you ended those 10 years with less money than you started with. During that same decade, quality dividend-paying stocks did something remarkable. Companies that consistently grew or initiated dividends, the dividend growers, returned 10.22% annually versus just 4.21% for non-dividend payers, according to Ned Davis research data. When price appreciation disappears entirely, dividends become the only return engine in the room. They kept depositing when prices were doing nothing but falling. This is the legitimate case for dividend investing that the math actually supports. As a buffer against lost decades, as a hedge against extended flat markets, and as a source of income that doesn't require selling assets at the worst possible time. But even within dividends, there's a massive trap that most investors fall straight into. The instinct when building a dividend portfolio is to chase the highest yield possible. 6%, 8%, 9% yields look incredible on a spreadsheet. The monthly income calculator shows life-changing numbers. And those high-yield stocks are almost always a trap. A Wellington management study going back to 1930 divided dividend-paying stocks into 5 quintiles by yield level. The highest-yielding stocks, the ones income chasers pursue most aggressively, did not outperform. They performed in line with the broader market at best, and frequently underperformed. The second quintile, moderate yield, strong consistent dividend growth, outperformed the S&P 500 in 6 out of 9 complete decades. Why do the highest yielders underperform? Because a 9% dividend yield almost always means the market doesn't believe the company can sustain that payout. High payout ratios, shrinking earnings, a business model under pressure. When the dividend gets cut, and with that payout ratio, cuts are a matter of when, not if, the stock drops 20 to 30% overnight. The income you built your strategy around disappears, and you take a major loss on principal at the same time. The second quintile dividend growers are different. They start at 1.5 to 2% yield, raise their dividend 8 to 12% every single year, maintain a healthy payout ratio, and have pricing power and growing earnings to back it up. A 1.5% yield today, growing at 10% annually, becomes a 6.5% yield on your original investment in 15 years, while the stock price has very likely tripled. That combination of growing income and growing principal is where the real compounding happens. So where does all of this leave you? The answer to the dividend versus index fund question is genuinely not one size fits all, but it depends on 3 variables that most of this debate ignores entirely. First, your account type. Inside a 401k or a Roth IRA, annual tax drag vanishes completely. Dividends reinvest with no immediate tax consequence. In a tax-sheltered account, the gap between the Schwab Dividend Fund and the Vanguard Fund shrinks considerably, and your personal preference for income versus total return becomes the legitimate deciding factor. In a taxable brokerage account, particularly if you're under 50, the math consistently favors index funds. Every deferred year of tax is another year of uninterrupted compounding. Second, where you are in life. If you're 5 years from retirement or already in it, dividend income solves a real problem: sequence of returns risk. Selling stocks to cover living expenses during a 35% drawdown permanently damages a portfolio in a way that living off dividend income does not. Retirees who can fund their lifestyle from dividends without touching principal have a structural advantage in down markets that a pure total return investor simply doesn't have. Third, your behavioral reality. The theoretically optimal strategy is worth exactly nothing if you sell when markets crash. If seeing your portfolio drop from $600,000 to $420,000 would cause you to liquidate, dividend income acts as a psychological anchor. The cash keeps flowing. The strategy feels like it's working. You stay in the game. That behavioral benefit produces real compounding dollars over decades, and those dollars matter more than the optimal theoretical model you abandoned in a panic. So here's what the real math actually says. If you are young, in a taxable brokerage account, and you have 20 to 30 years ahead of you, a total market index fund will almost certainly produce more absolute wealth. The historical performance gap, multiplied across decades and amplified by tax efficiency, compounds into a number that is genuinely hard to argue with. The math here doesn't care about feelings. If you need income to stay invested, if you are in retirement, if you are specifically buying quality dividend growers rather than yield chasers, or if you are in a tax-sheltered account, dividend investing is not a bad strategy. It is a different tool for a different job. Treating it like a universal wealth maximizer is where the mistake happens. The deposit hitting your account every month is real, but that deposit is your own capital returning to you, taxed, in most cases, rather than new wealth being created. Understanding that distinction, clearly and without the emotional framing that most dividend content wraps around it, is the thing that separates an investor who builds real wealth from one who builds a pleasant-feeling account balance. So here's the question I'll leave you with. Are you in dividends because the math told you to be, or because the monthly deposit makes you feel like you're winning? Drop your honest answer in the comments. I read all of them, and the responses from people who've run both strategies simultaneously and actually compared their results are always the most interesting. If this shifted how you think about even one investment decision, share it with someone who's deep in the dividend rabbit hole. They might not thank you immediately, but they'll thank you eventually. Hit the like button if this earned your time, and make sure you're subscribed. Because next week, we're getting into the one strategy that has actually outperformed both dividend portfolios and index funds over the past 20 years. The numbers are uncomfortable. You do not want to miss that one.